The 2026 federal budget made the biggest changes to property tax we've seen in decades. Negative gearing has been restricted, the 50% capital gains discount is being replaced, and in all the noise since May, most investors have missed the one thing the government left completely alone: tax depreciation. It wasn't touched, it wasn't reduced, and under the new rules, it's arguably more important than it's ever been. So in this video, I'll walk you through what's changing at a high level, what isn't, and what it means for the paperwork sitting behind your property. Here's the short version of the changes. From the 1st of July 2027, negative gearing is restricted for established residential property bought after budget night, and the 50% CGT discount is being replaced with a new system. Anything held before budget night is grandfathered, so existing positions keep the current rules. These changes are now legislated, but how they apply to you depends on what you own, when you bought it, and how you hold it, and that's not our call to make. We're quantity surveyors and valuers, not tax advisors, so your accountant is the right person to talk you through your own position. What we can tell you is what the changes mean for the two things we deal in every day: depreciation and valuations. And on both counts, the story is the same. They just became more important. Depreciation survived the budget without a scratch. The decline in value of the building itself, the capital works, and for eligible properties, the plant and equipment inside it. All of it is still claimable exactly as it was before. The legislation left the ATO's depreciation rules exactly where they were. And when one of your biggest deductions come through intact while the settings around it tighten, its relative value goes up. Whatever the new rules end up meaning for your situation, the deductions in the depreciation schedule don't disappear. They do have one condition though: they only exist if they're documented. If a deduction was never captured in a schedule, there's nothing there to claim. If you've never had one prepared, it's not necessarily too late, because schedules can be prepared retrospectively, and depending on your circumstances, your accountant may be able to amend past returns. The longer it's left, the harder that gets, so it's worth talking to your accountant sooner rather than later. The other thing this budget did, without saying it out loud, is turn record keeping into the main event. Once a new system starts, working out your position at sale time will lean heavily on evidence: what the building cost to construct, what's been claimed over the years, and in many cases what the property was worth at a specific point in time, which is where an independent valuation comes in. This is our day job. TDA prepares both sides of that evidence: the depreciation schedule and the independent valuation. We don't tell you what to do with them, that's your accountant's job. Our job is making sure that when your accountant sits down to work out your position, the numbers underneath are right. Before I wrap up, there's one thing I'd tell you not to assume, and that's that established property has stopped being claimable. It hasn't. The building allowance still applies where construction commenced after September 1987, and apartment owners often hold claimable value in common property like lifts, fire systems, and shared infrastructure. Whether an established property stacks up for you overall is a conversation for your advisor, but whether it holds claimable depreciation is exactly what a schedule tells you to do. So the takeaway is this: the rules around your property are changing, but the deduction underneath isn't. If your depreciation schedule is out of date, or if you've never had one, sorting it now means your records are ready before the new system arrives. We're TDA, Quantity Surveyors and Valuers. You'll find us at tdaqs.com.au or on 1300 417 317. Thanks for watching, and if there's a topic you want covered, drop it in the comments below.